Patrick, I know that maybe you and your team don't care about gas oil either. I only mentioned it because a 27% swing in a matter of hours, even for that, yes, thinly or traded contract, shows, does it not, to you, and correct me if I'm wrong, this is a nervous market that can move really fast.
Well, Brian, I mean, you're absolutely right. The volatility that we're seeing in markets is almost unprecedented, particularly with some of these commodities. And I think the question for investors is, how do you allocate, how do you pick stocks in this environment? And ultimately, it comes down to, where do you have conviction, and can you ultimately look through the noise that's happening on the day-to-day basis? There's plenty of great stocks out there. There's plenty of great opportunities. The question is, does the volatility throw off your timing? Does it throw off your mentality? But for those who can stomach it, I think the opportunities are very good right here.
Yeah, and you guys have a target that I think is about 19%. I think it's 5,200 on the, correct me if I'm wrong, Patrick, on the S&P. It's about a 19% gain from here. Obviously, that's a heavy lift. And we're not going to hold you December 31st, right? It's just the calendar. But have you guys thought about reducing your S&P 500 target?
Well, I think right now, with the VIX elevated at around 30 to 33, we're looking for that ultimately to come back in over the course of the year. And I think as volatility falls, we expect the market's going to make up a lot of the ground. I think the question which we are ultimately debating right now is, what is the potential impact from the ultimate crisis in Ukraine? Do we have a situation where higher oil prices result in significant demand destruction? Because there's a case to be made that higher oil and inflation is a very positive for corporate profits. The question, though, is whether or not it ultimately hits a decline in real sales. Companies live in a nominal world. Nominal sales are good. But if we see a fall in volumes, that's really the question. Right now, we don't have enough evidence to see that damage right now. But should that come through, we'd absolutely be open to revising that.
Yeah, I think you guys are probably making a lot of calls or messages to your chief economist and his or her staff, because it's like, at what point do we get that demand destruction? At what point, Patrick, does the consumer, faced with higher rent, higher milk, higher steak, higher fuel, they got higher wages, thank goodness, but is there a breaking point? Have you guys kind of identified where that may be yet?
Well, I think right now where most people are focused on is the breaking point with oil. It's one of the biggest inputs into the daily consumer's life, and it's one of the areas where we've seen the biggest move. Historically, I think that's been around $150 on oil, with what many people are talking about. I think oftentimes when you look back over time, though, particularly with 2008 was the analogy which most investors are making, we have a different environment, not only with how we live our life, but also with the ability to remote work, the ability to have alternative decisions, and also we have more efficient cars. So I don't necessarily know if that analogy is entirely appropriate, but I think there are certainly lessons to be learned. And inflation is the biggest issue. We'll get inflation data today. The biggest issue that is ultimately facing consumers. You're absolutely right. Wages have come through, and that's really helped. But ultimately, costs have come through as well.